Hello everybody, my name is Austin Roberts, and today we're going to be talking about one of the most frequently asked questions we've got so far this year because rates have gone up so much. Should I be paying points on my mortgage? Should I be buying my rate down? So today we're going to address number one, what are points? Number two, when does it make sense to pay them? And number three, if it does, how many points should you pay? Number one, what are points? Paying points is just paying more money up front for a lower rate that goes into your closing costs. And the way that people talk about them is in percentage points. So when a loan officer says, yeah, I can get you that rate, but it's going to cost 1 point, they're saying, yes, I can get you that rate, but it's going to cost 1% of the loan amount. If your loan amount is $400,000, that 1 point is $4,000. The more points that you pay at the beginning of your loan, the lower your rate is going to be and the lower your payment's going to be. Number two, now that we know what points are, when does it make sense to pay them? I like to say that paying points is like gambling at a casino. The house always wins. And the reason I say that is because when you're paying points, you're essentially putting money down today. You're betting money today that rates are not going to go down in the near future. And when you're betting money, somebody's going to win and somebody is going to lose. Yes, if you pay points up front, your monthly payment is going to be lower, but the question is how much lower? And the crazy thing is, if you pay 1 point today, it usually takes about 6 years of that lower monthly payment to make up for the cost that you pay upfront in 1 point, and even longer if you pay more than 1 point. And that's a really big problem because it is becoming less and less common for people to keep their mortgage for more than 5 years. So if you pay points and then rates drop and you refinance, the thousands of dollars that you just spent is wasted. Let's take this to the casino. You are the gambler, the points that you're paying are your chips, and your mortgage lender is the house. You walk up to a roulette table, but instead of there being red and black, there is rates will go down in 6 years, and rates will not go down for 6 years. If you were in a regular casino playing roulette, the odds of red and black would be the same. But in your casino, in your game of roulette, the rates will drop in 6 years has hit just about every single time for the past 40 years. Lenders over the past 40 years have loved to sell points because they can get paid in two ways. The first way is, if you buy points, they get a big check up front and then they get interest payments every month. And the other way is, if you do not buy points, then they are not getting that big check up front and they're getting a slightly bigger interest payment every month. Needless to say, they strongly prefer to get that big check up front, and because rates have continued to go down and people continue to refinance and those people continue to choose to pay points, they're getting that big check every couple of years. Remember, casinos know some days they're going to lose money at the roulette table, but they're going to win in the long run. Your mortgage lender knows they're going to lose some days when people pay points, but they're going to win in the long run. So most people should not gamble by paying points because the house always wins. So if you do pay points, you want to keep your loan long enough to see a positive return on your wager, right? The problem is when you ask somebody how long they're going to keep their loan, they almost always undershoot it. They don't know about the job offer their spouse is going to get that's going to lead them to move. They don't know about the remodel that they're going to do in a year where they're going to have to take some cash out. And they definitely don't know that rates are going to drop in a year or two. However, you do have to answer that question to know which loan is best for you. So whatever initial thought comes to your mind, maybe it's a little bit less. Like I said, it's becoming more and more common for people to keep their loan for under 5 years. Once you know that, we actually have a tool, our digital loan officer, that will tell you exactly which rate and which loan is best for you. You plug in a little bit of basic info, how much your home's worth, what your loan amount's going to be, where your credit is at, and then at the end, it's going to ask you how long you think you plan on keeping your loan. Once you choose a time frame, our digital loan officer analyzes all the different lenders that we work with and all of the different loans that they offer, and it spits back the perfect loan that makes sense for you and your time frame. And the way that it decides which loan is best for you is it finds a loan that's going to cost you the least number of dollars over that given time. And if you're a total nerd like I am, you can pop it open and see all of the factors that went into determining which one has the lowest cost for you, like the total interest you're going to pay, which rate leaves you with the most equity at the end of the day, and your adjusted loan amount rolling in your closing costs. This tool is awesome because it clearly shows you which loan is best for you and by how many dollars. And the great thing about it is if you decide, you know what, I probably am not going to stay in my loan for that long, you can scroll back up to the top, change your time frame, and it will select a new loan for you. The link to our digital loan officer is in the comment section, so please run your scenario through that tool before you let somebody talk you into buying points. Now remember, it is not necessarily a bad idea to pay points on your mortgage, but the problem is there are so many people who waste thousands of dollars every single day paying points because they do not keep their loans as long as they thought they were going to.